54% of Americans call themselves middle class. That number hasn't budged in decades, which is impressive because the finances behind that label absolutely have. Think of it like this. The government is telling you the jersey still fits, but your gut is bulging out of it from all sides. The most important pair of numbers most Americans have never seen placed side by side. From 1979 to 2024, worker productivity in the United States grew 80.9%. Average hourly compensation for workers, adjusted for inflation, grew 29.4%. Productivity grew at nearly 3 times the rate of pay. The economy became dramatically more efficient and substantially more profitable across those 4.5 decades. Workers captured a fraction of what that growth produced. The rest moved upward, quietly, a few cents at a time, in amounts too small to trigger outrage in any individual paycheck, but large enough to reshape the entire economy over time. The Economic Policy Institute has tracked this divergence for years. From 1948 to 1979, productivity and worker compensation grew at roughly the same rate. Workers got a proportional share of what their labor produced. After 1979, the relationship between what workers produced and what they were paid broke down. The timing isn't accidental. It coincides with the broad decline of union membership, a shift toward shareholder rule, and a series of policy changes that systematically weakened the bargaining position of labor relative to ownership. Where did the money go? Wages for the top 1% grew 181.7% since 1979. The top 0.1% saw wage growth of 353.9%. The bottom 90% grew 43.7%. The top 1% now earns 12.4% of all wages in the United States, up from 7.3% in 1979. The bottom 90%'s share of total wages fell from 69.8% to 60.7%. That's a massive redistribution executed gradually across decades, with no single visible moment the public was formally asked to weigh in on. It was the slowest heist in history, and everyone missed it because it's not like they ran into our homes and yelled, "Give me your money." The wealth picture is uglier. In 1963, the wealthiest American families held 36 times the wealth of families in the middle of the distribution. By 2022, that ratio had grown to 71 times. The top 10% of households now control over 87% of all corporate equities and mutual fund assets in the country. Between 2020 and 2024 alone, the minimum wealth required to enter the top 10% jumped from $1.3 million to $1.8 million, a 40% increase in 4 years. The U.S. median household income in 2024 was $83,730. The income threshold to reach the top 10% was $210,000. Those two figures are not converging. They are absolutely running away from you. The mechanism driving the gap wider isn't complicated. Asset prices surged. U.S. home prices rose between 45% and 53% from 2020 to 2024. Stock markets recovered from the pandemic and hit repeated new highs. Households that owned assets before the run-up captured those gains in full. Households that didn't, which describes a large portion of the middle class and most of younger working America, watched the distance grow from the outside with no mechanism to close it. It's the classic have and have not story. The wealthy have and all the rest of us have not. Sound familiar? Wealth doesn't compound for people who have none to start with. Now add what middle-class life actually costs. The Ludwig Institute for Shared Economic Prosperity tracks what it calls the true living cost, built around what lower and middle-income households actually spend on essential needs, not what government models assume they spend. In 2024, that index rose 4.4%. Median weekly earnings for full-time workers rose 3.9% over the same period. The result was a net erosion of real purchasing power in a year the financial press broadly described as an inflation success story. The year before, the True Living Cost Index rose 9.9%. So that's 2 consecutive years of falling behind, and the headlines called it a win. Must be rich people's math. Breaking it down, housing costs up 10.6% in 2024, the second largest annual increase since 2001. Childcare up 7.7%, the largest single-year childcare cost increase ever documented. Healthcare has grown at an average annual rate of 4.9% since 2001, the fastest compounding essential spending category over the long run. Pull the lens back to the 1980s. Housing is up roughly 118%. Healthcare roughly 200%. College tuition is approximately 300%. Wages over that same period, roughly 65%. Every line item that makes a stable middle-class life possible has outpaced income growth by a substantial margin and has been doing so long enough that the gap is now structural. To afford a median-priced home today while keeping housing costs below 30% of income, a buyer needs to earn $121,400 per year, per the Federal Reserve Bank of Atlanta. The median household income is $83,730. That $37,000 gap isn't a rounding error. It's a wall. Goldman Sachs estimates meeting existing housing demand would require building 4 million additional homes beyond current construction rates. Those homes are not being built. Homeownership, the foundational vehicle through which middle-class families have historically built generational wealth, continues moving out of reach for younger households at precisely the moment asset appreciation is running fastest. The generational divide is specific. 33% of 27-year-olds own a home today, compared to 40% of baby boomers at that same age. The millennial homeownership rate in 2024 was 54.9%. The baby boomer rate is 79.6%. The standard counterargument is that boomers faced mortgage rates above 16% in the early 1980s. That's accurate, but they were buying homes at a fraction of today's prices. Their average monthly housing burden at those rates came to 33.2% of median income. Today's buyers face rates between 6 and 7% on homes that have risen more than 50% since 2020. The issue isn't the rate, it's the rate on top of the price, on top of a wage base that hasn't kept pace with either. Add the student debt weight boomers largely did not carry. Total U.S. student loan debt now exceeds $1.7 trillion. Average debt per borrower grew 107.6% between 2007 and 2024. Nearly half of millennials with any college attendance carry student loan debt into their 30s, compared to 13% of baby boomers at the same age. That debt loads into debt-to-income calculations at the mortgage stage, competes directly with down payment savings, and delays homeownership by an average of 7 years. 7 years of missed equity accumulation during the steepest sustained home price run in modern history. The stress is showing up in the credit data. Average household credit card debt reached $8,000 in 2024. The average APR now exceeds 20%. A household carrying average credit card debt and making minimum payments is losing ground every single month, paying more in interest than they're paying off the principal. 73% of workers reported struggling to cover basic living expenses in a 2025 survey by Forbes and Resume Now. These are middle-class statistics. They describe what happens when the monthly math stops working and a credit card becomes the solution to a structural problem it was never designed to solve. I remember trying to choose between either putting gas in my car or paying my school loan. I decided to buy cigarettes instead and took the bus. Here's where the measurement problem compounds everything. The Consumer Price Index, the number used to annually adjust Social Security benefits, the child tax credit, and over 15 other federal programs, doesn't accurately reflect costs for lower and middle-income households. The CPI assigns less than 25% of its housing weight to rent, effectively assuming most Americans own their homes. Among the bottom 60% of households by income, only about half were homeowners in 2020. The index also largely excludes health insurance premiums, which account for more than 60% of all medical costs for those same households. Gene Ludwig, former U.S. Comptroller of the Currency, put it plainly: the gap between headline inflation and the real cost of living remains significant, especially for Americans with little margin for error. In 1970, middle-income households accounted for 62% of all aggregate household income in the United States. By 2022, that share had fallen to 43%. The share of Americans living in middle-income households declined from 61% to 51% across the same period. The top 10% of income earners now account for nearly 49% of all U.S. consumer spending, up from 43% in 2020. The economy is growing structurally dependent on a narrow band of high-income households to drive demand. When that dependence deepens over this long a period, the system becomes more brittle in ways that growth figures will not reveal until the pressure becomes unsustainable. In the past, that was when the villagers brought out the torches and the pitchforks. The middle class isn't disappearing in a single visible event. It's compressing year by year through forces that appear manageable by themselves, but all adds up like eating your lunch for you and still asking you for a tip. The productivity gains were real. The economic growth was real. The rising asset values were real. None of that went to the working class, though. I'll give you an ice cream if you can guess where it did end up. If this video gave you something you didn't have before, leave a comment below. Please like, subscribe, and hit the notifications tab if you already haven't. If you like this video, you may like this next one in the top left corner.